first topic we're going to touch on tonight, which will consume actually the first few slides, is going to be the topic of personal income tax. Now, within the topic of personal income tax, we're going to go over some tips that may be useful to everyone. The first tip deals with capital gains. Now, almost everything we own is a capital asset. Some examples are going to be a home, household furnishings, stocks, bonds, etc. Anytime a capital asset is sold, the difference between the selling price and what you paid for it originally results in either capital gain or capital loss. Now, when the asset is sold, besides the cost and the selling price, you must look at how long you've owned that asset. If you've owned that asset a year or less, you're going to have a short-term asset. If you've owned it a year or more, you're going to have a long-term asset. Now, depending on your tax bracket, your capital gain could be taxed at 0%, 10%, or 15%. Now, if your income exceeds $413,000 if you're single, or $464,000 if you're married, then your tax bracket is going to be 39.6%, which is the top tax bracket, and your capital gains are actually going to be taxed at 20%. The second tip we're going to go over again deals with capital gains, but this is in regards to capital losses. And I made this a separate slide because there's some special rules that apply to capital losses. First, you cannot deduct any losses that you incur as a result of your personal use property. This means the losses from the sale of your car, your house, you cannot deduct those. In addition, the IRS places a $3,000 maximum loss deduction that you can take every year. So this means that if you're doing income taxes for the year and your capital losses are over $3,000, or your losses exceed your capital gains over $3,000, and you're limited to just $3,000 for that year's tax return. Any remaining losses that could not be deducted are going to be carried forward to future years, but again at a $3,000 maximum deduction per year. Another thing to remember about the $3,000 deduction is that it is cut in half if your filing status is married filing separately. Now, when you have sold a capital asset and you're doing your own income taxes, you're going to have to report the sale on Form 8949 of your federal tax return. Then, whatever gain or loss that you have from that form moves over to your Schedule D of your normal tax return, your 1040. The third tip deals with the taxation of pensions. Now, there are two general rules when it comes to the taxation of pensions. First is that any money you receive from a pension or retirement plan that you did not contribute to, or you use tax-free money to contribute to, will be entirely taxable to you. An example of this plan is going to be where the entire retirement plan or pension plan is entirely funded by an employer, and the employee does not contribute or deposit any money into that plan. The second rule is that any money you receive from a pension or retirement plan that you contributed to by using already taxed money will only be partially taxable to you. Now, an example of this is going to be when an employee is paid from the employer, and then the employee takes those wages and invests them into a retirement plan. The amount of money invested into the plan by the employee is not taxable because it's already taxed. However, any gains that occur because of that money are going to be fully taxable because the gains were not taxed before. Now, there's also a 10% penalty on any money that's taken out of a pension or retirement plan before you reach age 59 and a half. This means that any money you receive from a pension or retirement plan before age 59 and a half will be taxed at your normal income tax rate plus an additional 10% penalty for withdrawing the funds early. Now, there's a few exceptions to this rule. Some of those are going to be permanent disabilities, death of a plan participant, or equal periodic payments. The fourth tip we're going to go over deals with the taxation of retirement rollovers. Now, a rollover is when a person withdraws or takes out money from one retirement account and moves it into another retirement account. If you do that correctly, then the transfer of money from one retirement account to another is not taxable. Now, one requirement for a valid retirement rollover is that the retirement plan distribution is an eligible distribution. An eligible distribution has to be because it's made because of a hardship or a requirement of distribution or non-taxable already. Now, another requirement for a valid retirement rollover is that the money must be transferred into the new account within 60 days of receiving the money. If the money is not transferred within the 60-day window, then the money was not transferred within the time frame and will be completely taxable to you. Even if you transfer the money into another retirement account on day 61 or any time thereafter, all of it will be taxable to you. And an additional 10% penalty is applied, again, on any money that's distributed if you're under age 59 and a half, or that is not rolled over within the 60-day window. Now, the fifth tip deals with renting out vacation properties. Now, if you have any real estate that generates rental income for you, you have to report this income and your expenses on Schedule F, as in Frank, of your personal tax return. There are certain limitations that can apply if you use the real estate for personal and rental purposes. The IRS considers real estate used personally if you use the property for yourself for the greater of 14 days or 10% of the total amount that you rented out the property. If you use the property for personal purposes as well as rental purposes, then you must divide the property's total expenses between the rental portion and the personal use portion. In addition to having to divide the expenses, you will not be able to deduct any rental expenses in excess of your rental income for that property. So some examples of deductions that can be taken for rental property are going to be mortgage interest, real estate taxes, casualty losses, utilities, maintenance, and of course depreciation. Now, the sixth tip deals with Social Security benefits. Now, if you or someone you know receives Social Security benefits, or you'll receive them soon, here's some tips that you need to remember. First, if your only source of income is Social Security, then your benefits will not be taxable, and you should not have to file an income tax return. However, if you have other sources of income in addition to Social Security, then a portion of your Social Security benefits will be taxable. Now, the taxable amount is determined by the amount of income from your other sources of income. But the maximum taxable amount is 85% of your Social Security income. In order to report your Social Security benefits on your tax return, you need to make sure that you receive a Form 1099 SSA from the government telling you how much you need to report on your taxes. The seventh tip deals with the taxation of canceled debt. Now, the cancellation of debt, meaning any debt that you're personally responsible for, can be taxable to you. Around the office, we call this phantom income or ghost income because it's actually not money that you received, but the IRS treats it like you did. However, if you are not personally responsible for the debt, then the debt will not be taxable to you when it's forgiven or canceled. The taxation of the canceled debt only applies to the person who was relieved of the debt, meaning the person who was personally responsible for it. If you have any canceled or forgiven debt, you should receive a Form 1099-C from the creditor that gave or forgave the debt. You will then need to report it as ordinary income, so your normal tax rate, for that year's income tax return. Because it is an ordinary income, again, it's taxed at your normal tax bracket. Now, there are some exceptions to this rule that canceled debt is taxable to you. Some of those exceptions are going to be listed here on the slide, but the most common ones are going to be exceptions for student loans, bankruptcy, like Rachel Foley talked about previously, or insolvency. Now, the eighth tip deals with the deduction of personal medical expenses. Now, this tip marks a change from talking about income and moving into expense category. If you itemize your deductions for a tax year, then you may be able to deduct your personal medical expenses, and these expenses, if deducted, are going to be reported on your Schedule A. Unfortunately, you are only able to deduct the amount of medical expenses that exceeds 10% of your federal adjusted gross income. So, for example, if you made $100,000 in a year, then you're only going to be able to deduct for medical expenses any amount that exceeded $10,000. The first $10,000 is not taxable to you. Oh, I'm sorry, not deductible for you. Now, in order to try and exceed the 10% threshold, you're able to use medical expenses of a spouse if you're filing a joint return, or any of your dependents if you claim them on your return. Some common examples are going to include ambulance services, dentures, and even medical mileage. Now, there are a few more common expenses listed on the slide here, and later on we're going to go into a little more of the more bizarre medical expenses. Now, the ninth tip deals with the deduction of mortgage interest. Now, anyone who owns a home as their primary residence and has a mortgage on the property can deduct the mortgage interest as an itemized deduction on Schedule A of your tax return. In order to deduct the amount that you paid, you'll need to use Form 8396. Now, typically you'll receive a Form 1098 from your mortgage company, which lets you know how much mortgage interest that you paid for that year. However, it's important for you to note that you're only able to deduct the mortgage interest that you actually paid yourself. It's very common for older parents to pay for their children's mortgage while the children get back on their feet. If this occurs, the older parents are able to deduct the mortgage interest paid by them. The child cannot deduct the mortgage interest paid by their parents. Now, the 10th tip deals with deduction of donations to charity. This is another itemized deduction that's taken on your Schedule A. You can generally deduct the full amount of the donation as long as it is to a qualified nonprofit organization. Some examples of qualified nonprofits are going to be churches, governments, hospitals, Salvation Army, United Way, Boy Scouts of America, and the American Red Cross. Some examples of non-qualified nonprofits are going to be sports clubs, labor unions, tuition, chambers of commerce, homeowners associations, and political groups. Now, in order to take the charity deduction, you can donate money or property. The property can be personal property or real estate. If you contribute personal property, you can take a deduction on the fair market value of the item at the time it was donated. It's also important to receive a statement from the charity listing the items that you donated, their value, and the date that they were donated so you can document your charitable donation. However, no matter how much that we all wish we could, you cannot deduct the value of your time or services. For example, if you take a pro bono nonprofit case and you have 40 hours in it and you bill $200 an hour, let's do some math here, you can deduct none because you cannot deduct your time. Now, in 2015, there are other limitations that have happened. So for 2015, if your adjusted gross income for single is over $258,000 or $309,000 if you're married, your total contributions are 20% or less of your AGI, then the limit does not apply to you. But the amount that you may be able to deduct could be 50, 30, or even 20% of your AGI, depending on the type of contribution that you make. Now, one thing that could be a benefit to tell clients in order to get them to pay you to prepare their taxes is that they can deduct your tax preparation fees. And this is an often overlooked itemized deduction that really anyone can take the deduction as long as they paid someone to prepare or assist in the preparation or review of their income tax return. Now, this is also deducted on Schedule A. Now, the tax preparation fees include any money that you paid to a tax attorney, an accountant, a bookkeeper, or a tax preparation software program that you use to prepare your federal tax return. This also can include any fees that you paid to electronically file your return. However, the fees are not deductible unless they exceed 2% of your federal adjusted gross income. Now, something that we all had at one point or still have if you went to law school, the deduction of student loan interest. While your student loan payments may be killing your wallet, Uncle Sam wanted to give us a little bit of relief of that financial stress by allowing us again to deduct the interest that you paid in the tax year that you paid it on your student loans. The deduction is taken on the first page of your federal tax return and can be taken regardless of whether you itemize or not. This means that the deduction is not limited to 10% or even 2% of your adjusted gross income. But there are some limitations to taking the deduction. First, you cannot file married filings separately. Second, you cannot be claimed as a dependent on someone else's return. However, you can deduct any interest paid by your dependents or on behalf of your dependents. Now, in order to figure out how much interest you paid for the year, your student loan company will send you the amount of interest that you paid on a Form 1098-E. Now, this deduction is reduced as your income grows. Now, what do I mean by that? We call this a fade out. So for 2015, if your adjusted gross income was between $65,000 and $80,000 for a single person, meaning $130,000 and $160,000 joint, then you're going to be phased out of this deduction, and so it doesn't matter how much student loan interest you pay, you cannot take a deduction for it. Tip number 13 deals with the deduction of alimony or maintenance payments. This slide is for all the family attorneys that may be in the room. Alimony that is received by a taxpayer must be included on that person's tax return. Anyone who pays alimony can deduct the alimony payments on the first page of their federal tax return. But in order to make the payments deductible, a few rules must be met. 1, the alimony must be paid in cash, check, or money order. 2, the divorce decree between the former spouses must designate the payments as alimony. The child support obviously is not deductible, and neither are property settlement payments. And 3, alimony payments must stop at the death of the former spouse. If they don't stop at the death of the former spouse, then the IRS does not consider them alimony. Well, tip number 14 deals with the deduction of tuition and fees. This is another deduction designed to help students and former students with their debt. And this is also taken on the first page of your income tax return. This deduction allows you to deduct the cost of tuition and related expenses that are paid for the taxpayer's spouse, or the taxpayer's dependents. The downside to this deduction is that it cannot be used in conjunction with the education credits. While the education credits can result in a tax refund to a taxpayer, this tuition and fees deduction just reduces the amount of tax owed as low as possible. No refund can be generated because of this deduction. Now, tip number 15 deals with the American Opportunity Credit. The American Opportunity Credit is one of two education credits that can be claimed by a taxpayer. In order to take this credit, you're going to file Form 8863. Now, it is a refundable credit, again, meaning that it can generate a refund even if there is no tax due for the taxpayer. The maximum credit per year is $2,500, and of that amount, only 40% can be refunded. Now, it's only available for the first 4 years of college. After that, it's not available. And in order to be claimed, the student that incurred the education costs must be pursuing a program leading to a degree or other recognized educational credential, and must be enrolled at least half-time for the tax year. A taxpayer can claim the credit for education costs for the taxpayer or your spouse if you file a joint return, or any of your dependents as long as you claim them. Now, qualified expenses are going to include tuition, enrollment fees, course materials, and books. Now, tip 16 is the lifetime learning credit. This is the second of the two education credits that can be claimed by a taxpayer. Now, if this credit is going to be taken, just like the American Opportunity Credit, you're going to file Form 8863. It is a non-refundable credit, meaning that it does not generate a tax refund. It only reduces a taxpayer's tax debt. The maximum credit allowed is $2,000 per year. It is only available, it's only available for an unlimited number of years, and it's not subject to a 4-year limitation like the previous one. Another benefit is that the student claiming the credit does not have to be pursuing a degree or other recognized educational credential. In addition, there's no requirement that the student go half-time or full-time. A taxpayer can claim the credit for education costs for, again, yourself, your spouse if you file a joint return, or any of your dependents if you claim them. And, just like the previous credit, qualified expenses include tuition, enrollment fees, course materials, and books. Now, tip number 17 deals with the deduction of child and dependent care expenses. A taxpayer whose filing status is not married filing separately is able to receive a credit for any money paid for the care of a qualifying child or dependent, so that the taxpayer was able to work or look for work. This credit allows a maximum of $3,000 per qualifying child, with an overall maximum of $6,000. In order to be a qualifying child, the child must be under age 13 or a dependent who is physically or mentally disabled. The care must be provided by a qualified organization and cannot be your spouse, a child's parent, one of your other dependents, or anyone under the age of 19. Now, in order to take the credit, you must report the organization's EIN number or the person's Social Security number on the form. Tip number 18 deals with the child tax credit. Now, the child tax credit is given to any taxpayer who has a qualifying child. It's separate from the child independent care credit, which we just talked about. It is also separate from the additional child tax credit. A qualifying child must be related to you, under the age of 17 at the end of the tax year, live with you for more than half the year, and you claim them as a dependent on your tax return. The credit can be reduced to zero if you're filing as married joint, with an adjusted gross income over $110,000, or you're single with an adjusted gross income over $75,000, or married separate with an income over $55,000. The additional child tax credit is for taxpayers who were not able to claim the full amount of the child tax credit for one reason or another. Now let's get into a very popular credit, which is the Earned Income Credit. Now, the Earned Income Credit, or known as the EITC, is the very popular income tax credit that essentially allows the government to pay people who are of low income or moderate income families. Now, in order to qualify for EITC, you must have an earned income, meaning you actually worked instead of just having investment income or passive income, and you must fall under the strict income guidelines based upon your household size and filing status. The amount of credit that a taxpayer receives is also based on the taxpayer's income that they received during the year, in addition to their filing status and household size. Now, in order to determine the correct amount of EITC that you can claim, you can, as a tax preparer, you can use your tax preparation software. If you don't have any fancy software, you can use the IRS's EITC assistant, or you can do the old-fashioned way and use the EITC IRS tables. Now, the EITC assistant is a free web tool that the IRS allows anyone to use in order to determine if they qualify for the earned income credit, and if they do, how much they should receive. It's a very straightforward and easy tool that's available on the IRS website that should be very easy to understand. Now, tip number 20 deals with the different tax deadlines that we should all be aware of, and this tip marks the change from speaking about expenses to speaking about some general information that people may have some confusion about or questions about. Now, hopefully everyone knows that their personal tax returns are due April 15th. This deadline also includes partnership returns and estate and trust returns. Now, you might be saying, hey Cameron, don't trick me here. This tax year it was due on April 18th. Now, why it was due on April 18th this year is that Washington, D.C. celebrates what they call Emancipation Day, which that day was signed into law by President Lincoln by the Compensated Emancipation Act, and was subsequently given as a legal holiday to the residents of Washington, D.C. Now, it's usually, this year it was being observed on April 15th instead of its usual day, April 16th, causing the tax day for everyone in the country to be moved to the following Monday, giving tax preparers an additional weekend to work, and that's why our tax day was the 18th, not the 15th this year. However, most people don't realize that corporate tax returns are due March 15th. Now, all employers must mail out their W-2s and 1099s to employees and independent contractors by February 2nd. Nonprofit organizations must file their returns by May 15th. IRAs must send out Form 5498, which is just a form that reports your account balance if you have an IRA, by June 1. And if you filed an extension for your personal return, then your extension will go to October 15th. If you filed an extension for your corporate tax return, your extended deadline is September 15th. Now, tip number 21 deals with the different ways you can pay your tax bill. The IRS Direct Pay allows you to have your tax bill deducted directly out of your checking or savings account, and there's no charge for this option. The IRS also accepts debit cards and credit cards. However, you must use one of the 6 different payment processors that the IRS accepts. There's a fee for using this service. It's usually $2.75 for debit cards, or almost 2% for credit cards. But between the 6 processors, most credit cards are accepted. Now, the IRS Electronic Federal Tax Payment System, or what we normally call EFTPS, allows a taxpayer to pay their tax bill online or over the phone. There's also no charge for this option. However, this option is usually used by employers needing to make their quarterly tax deposits or their payroll tax deposits, not an individual income taxpayer. Of course, the IRS accepts checks. If you choose to write a check to the IRS, make sure that you make your check payable to the Department of Treasury. Don't write Internal Revenue Service. This also applies for money orders. Now, an installment agreement is where a taxpayer cannot pay the full amount of their tax bill and therefore needs a monthly payment plan. You can usually get a 5-year payment plan on your tax bill, but there's a fee of $120 to set that up. Now, an offer in compromise is where a taxpayer cannot pay the full tax bill up front or in monthly payments. So this option allows the taxpayer to make an offer to the IRS in hopes that the IRS will accept less than the balance owed. This option costs $186 and also requires a full disclosure of the taxpayer's assets and liabilities. Tip 22 deals with the different ways that you can receive your money if the government owes you money. And while there are many ways to pay the IRS, as you saw, there's only a few methods to get money back from them. The first method, direct deposit, is obviously the most popular and most favored method by taxpayers. It's a free service that automatically deposits a tax refund in your checking or savings account. You can even have the IRS split the tax refund up into different accounts instead of having one large deposit. This method is the fastest way of getting money from the IRS, with the average wait time of 21 days from the acceptance of your e-filed return. Now, the second method, U.S. Series 1 savings bond, is probably the least favored method of getting money back from the IRS. This allows a taxpayer to use all or a portion of your tax refund to buy a savings bond for you or for anyone else that you choose. The amount of the bonds purchased must be in $50 increments and are made possible by completing Form 8888. Now, the third method, a paper check, is the slowest method of getting a tax refund. This option is available to anyone who does not desire or does not qualify for direct deposit or obtaining a savings bond. Under this method, the taxpayer receives a check from the IRS for the amount of the tax refund. The disadvantage of this method is that it can take up to 12 weeks or longer to process the refund check which is mailed to you, and downside as well, the check could be lost in the mail, further elongating the process. All right, so tip 23 deals with the different penalties that can be assessed to an individual because of their personal income tax return. The first penalty is not really a penalty, but it occurs so often that I thought I would mention it. Now, any unpaid amounts to the IRS accrue interest from the due date of the return until the date of payment. The interest rate is determined quarterly and is the federal short-term rate plus 3%. Interest compounds daily. The failure to pay penalty is assessed on any amount of tax that remains unpaid from the due date of the return until the date of payment. Similar to interest, this is assessed when the taxpayer does not pay their full tax bill on time. The penalty is 0.5% for every month that the tax goes unpaid, up to a maximum of 25%. Now, the failure to file penalty is assessed on any taxpayer who does not file a timely tax return or a timely extension request and owes money to the IRS. This penalty is 5%, not 0.5%, but 5% for every month the tax return is late, up to a maximum of 5 months. The minimum penalty for a return 60 days late or more is $205 or 100% of the tax, whichever is less. Now, tip 24 deals with the different documents that you can request from the IRS in order to get help to prepare or figure out your tax situation. Now, there are 5 main types of transcripts that are listed on this slide. However, the first 3 are really the most commonly used. An account transcript is very useful because it will give you all the basic information that any taxpayer would want to know, such as your filing status, adjusted gross income, payments, credits, and taxes owed. It also shows any activity that the IRS has taken, including appointing an IRS representative and making adjustments to the return. A return transcript is very useful when a taxpayer has lost or does not have a copy of their income tax return. This transcript gives us a line-by-line explanation of what was filed by the taxpayer for that tax year. Now, a wage and income transcript is very useful when you're trying to prepare a tax return, but the taxpayer has lost all of their information. This transcript gives you a listing of all the informational returns that were sent to the IRS for a given year. This includes W-2s, 1099s, and 1098s. Now, the fourth one, a record of account transcript, is just a combination of the account transcript and return transcript. And the verification of non-filing transcript provides written proof from the IRS that a taxpayer has not filed a tax return for a certain year. However, you can also get this information in the account transcript, and that's why it's not widely used. Now, we mentioned tip 25 briefly, but it deals with the offer in compromise. Now, this is an agreement between the IRS and the taxpayer that settles the taxpayer's debt and allows the taxpayer to pay less than the full amount that is owed. Whenever you watch TV and you see a commercial where people are claiming that they settled their IRS debt for pennies on a dollar, this is what they're talking about, this program right here. Now, an offer in compromise is difficult to obtain because it's not very often that the IRS allows someone to pay less than what is fully owed. Now, in order to qualify for an offer in compromise, you must satisfy the requirements of one of the 3 types. The first type, doubt as to liability, is when the taxpayer and the IRS have a genuine dispute as to the existence or amount of the correct tax debt, and therefore the taxpayer wishes to resolve the matter rather than fighting to the death with the IRS. Doubt as to collectability is when the taxpayer admits to owing the full tax debt, but the taxpayer's assets and income are so low that there is no reasonable method for the taxpayer to pay off the taxes owed. The third type falls under effective tax administration. Now, this occurs when the taxpayer admits to owing the taxes and they have the income and assets to pay in full, but some other reason exists that if the taxpayer was forced to pay the debt, they would experience some sort of severe economic hardship that would be unfair or inequitable to the taxpayer. Tip 26 deals with the innocent spouse tax relief. Now, an innocent spouse claim occurs when married taxpayers file a joint income tax return. A tax liability is incurred, and one of the spouses wants to back out of the joint return and get out of being responsible for the taxes incurred. A simple way to remember this is essentially the blame it on your spouse relief. Similar to the offers in compromise, there are 3 different types of innocent spouse relief. The first is called innocent spouse relief, which is when your spouse forgot to report their income, reported their income improperly, or reported improper deductions or credits, and you don't want to be responsible for their mistake. This is basically the kick your spouse when they're down method. The second type is called separation of liability relief, and this is when both you and your spouse owe taxes, but you don't want to be responsible for your spouse's taxes, so you make this relief request so that you're only responsible for your portion of the taxes and your spouse is responsible for their portion of the taxes. This is basically the divorce your tax debt method. Now, the third type, again, is equitable relief, which is when you don't fit into the first 2 categories, but you need some sort of assistance still because you would experience a hardship if you were forced to pay your spouse's tax debt. Now, I know we talked about rollovers previously, but tip 27 is a updated slide for the rules on IRAs and other qualified retirement plans. And this is when we mark the change from dealing about general information to some recent tax developments that have occurred over the past 2 years. Now, this first case that I have down below is the Bobrow case. Now, this case involved the tax lawyer and his wife with 3 different IRA accounts. The Bobrows took distributions from each of their IRAs, but redeposited the distributed money back into each IRA when they withdraw the money. So essentially they needed some quick cash, took it out of their retirement account, and put it right back into the same account. The Bobrows then treated each of these transactions as non-taxable because they took out money, but they put it right back. The IRS treated the first distribution as non-taxable, but the IRS wanted to tax them on the second and third transaction. The Bobrows argued that the IRS claiming that each retirement account is eligible for the non-taxable treatment because they were rollovers. Now, the tax court ultimately sided with the IRS in this instance, stating that a taxpayer is only allowed 1 non-taxable IRA distribution or rollover per 12-month period. The tax court ruled that the 1 non-taxable distribution rule applied per taxpayer, not per account. Therefore, the first rollover was good, but the 2 other distributions that were rollovers were in fact taxable. Now, the tax court also noticed that the third rollover done by the Bobrows was done 61 days after the distribution and not within the 60-day window. The Bobrows argued that they had kept the funds in a Fidelity account within the 60-day window, and it was Fidelity's mistake for missing the 60-day window. Tax court ruled against them there as well, stating that it's the taxpayer's burden and not the manager of the funds to satisfy the 60-day window deadline. Now, tip 28 deals with a big change for builders of residential developments. Now, the 2014 tax case Shea involves a builder who was building a residential community. As part of the community, Shea was building homes, parks, swimming pools, and other very nice community amenities. The problem is that Shea was not reporting the income from when he sold a home in the community because Shea claimed he was following the completed contract method. Now, what's this method? It allows a builder to not recognize any income until the entire contract is completed. Now, Shea argued that the contract was not technically complete until the entire residential community was built, not just the individual houses. The IRS disagreed with Shea and wanted the builder to recognize the income from the sale of the home when the house was sold. They didn't care when the overall community was finished. If the IRS was correct, Shea would have to recognize nearly $900 million in income from the sale of the homes immediately. So we're not talking about small change here. The tax court, lucky for Shea, sided with him, stating that the income should not be recognized until the entire development was finished. But in order to qualify for this deferment, the contract for the sale of the home should be in effect for 1 year or more, reference the common improvements that are being made, and the purchase price should include some of the costs of the common improvements. Tip 29 deals with the big change for tax return preparers and how they are different than tax practitioners. Now, although this case is a tax court case and it comes out of the DC Circuit, it still sends a big message to the IRS regarding their regulation of tax practitioners. Now, Ms. Loving, who's involved in this case, is not a CPA, an attorney, or even an enrolled agent. However, she prepared tax returns in exchange for compensation. She then sued the IRS, stating that the IRS had no power to regulate her because she did not practice before the IRS and was not subject to Circular 230. Circular 230 is a giant rule book that practitioners need to follow before the IRS. The IRS argued that a tax return preparer is representing taxpayers before the IRS through the preparation of income tax returns and therefore is subject to IRS regulation. The DC Appellate Court disagreed with the IRS, stating that filing a tax return does not fall under the category of a tax representative and therefore is not subject to IRS regulation. This court case struck down the IRS requirement that tax return preparers had to certify themselves, take a test, and take continuing education courses in order to be a tax return preparer. That's the IRS regulation that she was fighting. The court also ruled that the IRS has the ability, though, and the ability to regulate and charge for P-10s. Now, if you're not familiar with a P-10, it's basically your IRS Social Security number that allows you to file tax returns on behalf of people. Now, in another case, but around the same time as the 11 case, the court ruled that a tax practitioner subject to Circular 230 cannot charge contingent fees. However, any work that is done that is not subject to Circular 230, such as filing a claim for a refund, can be charged a contingent fee. Now, tip number 30 deals with the tax treatment of distributions from an LLC. It's been a long-standing rule that limited partners of a partnership or an LLC were not subject to self-employment on their distributive shares. Their distributive shares were the portion of the profits for that year from the partnership or the LLC. The IRS stated that because, in this case, they were limited partners and did not really add anything to the business other than money, their distributive shares were not subject to self-employment. However, the IRS has recently ruled that partners of a partnership or members of an LLC that provide services to the business or help manage the business are not limited partners. And because they're not limited partners, their portion of the profits for that year are subject to self-employment taxes. Now, this is a huge change for everyone because for years, tax practitioners have been telling their clients that their distributed shares from the LLC or partnership that they work in are not subject to self-employment. Now the question becomes, are you a limited partner or not? Now, with a little bit of time we have left, because I know everyone's anxious to get home, let's skip to some fun ones. Tip 35 is the start of some bizarre and strange tax tips that we're going to go over. And this one, obviously, it goes over the deduction of expenses incurred for a bodybuilding trade or business. Now, this comes from a 2004 tax court case involving a bodybuilder. Now, Mr. Weir was a bodybuilder who attempted to deduct some bodybuilding expenses because he believed he was in the business of bodybuilding. Some of his expenses were bison meat, which he ate at 3 pounds per day, vitamins, protein shakes, body sprays, massage oils, and bodybuilding outfits. The IRS argued that Weir's bodybuilding was a personal activity and was not a business of any sort, and therefore none of the items could be deducted. The tax court ruled partly in favor of the IRS, stating that the bison meat and protein shakes were not deductible because those were items that could be consumed by the general public and therefore were everyday food items. But the tax court ruled partly in favor of Weir as well, stating that the cost of the lotions and oils were deductible because those certain products were only available to bodybuilders through a bodybuilding magazine and therefore were not generally available to the public. The tax court also ruled that bodybuilding outfits were deductible because they were not suitable for normal wear outside of bodybuilding and were an ordinary and necessary expense for bodybuilding. Now, I know as attorneys left in the room, we all have this client, drug dealers. Well, believe it or not, there's tax tips for them as well. So the tax code requires the reporting of any and all income from drugs, regardless of their legality. This means that every drug dealer or drug farmer must report their income from the drug trade to the IRS so they pay their fair share of taxes. Now, unfortunately, Internal Revenue Code 280E states that any deductions from an illegal drug business are not allowed. The definition of an illegal drug business is defined by the drugs that are deemed illegal by the federal government, not the states. This means, for example, that medical marijuana dispensaries in Colorado and California must report their marijuana income but cannot deduct their marijuana expenses. Now, this rule is all-encompassing for expenses related to the illegal drug business, including rent paid for the property used in the drug trade, the soil that the drugs are grown in, and even the Ziploc bags that the drugs are used to be transported with. Now, however, there is a little bit of hope for all of your drug lord clients. The IRS does allow drug dealers to take a deduction for the cost of their goods sold. So this means a drug dealer can deduct from their income the cost of the drug from the dealer or supplier that they got to reduce some of their taxable income. And to help drug dealers figure out what their cost of goods are, the IRS even issued a 2015 guidance, and I've listed that, well, I'll give it to you. It's ILM 2015-04011. I'm sure you're all looking it up right now as we speak. But this assists drug dealers to determine how they should figure out their cost of goods sold. Now, it's an oldie but always a goodie. Tip number 27 deals with the ability of a taxpayer to depreciate the cost of her or his breast implants. Now, the Hess case, which is a tax court case, deals with an exotic dancer who went by the name of Tonda Marie. Tonda decided that in order to further her career, she needed to increase her breast size to a size 56FF. Now, the court estimated that each breast weighed about 10 pounds. I don't know why the court went into this analysis, but they did. And the cost of her surgery was around $5,400. Now, this is back in around 1992. After her breast surgery, she then changed her name to Chesty Love. This is an actual photo of her on Jerry Springer. Tax law states that a taxpayer cannot deduct or depreciate an expense that is considered personal. The court defined a personal expense as money spent on an item that is for personal comfort or convenience. Now, the court went on to say that Miss Love's breasts were so large, and I'm quoting the court here, they even called her freakish, that there's no possible way that Miss Love could find any comfort or convenience in her large breasts, and therefore she was allowed to depreciate the cost of her implants. Let's go to one that applies to all of us in this room. Tip 41 deals with the ability of a taxpayer to deduct their work clothes and uniforms. Now, a taxpayer is able to deduct the cost and upkeep of their work clothes as long as the clothing is required for their employment and the clothing is not suitable for everyday wear. Now, in one case, the IRS ruled that an attorney could not deduct the cost of his suits, no matter how fancy those suits were, because the suits could be worn in everyday life, such as for weddings, funerals, or even parties. However, in a separate case that same year, a taxpayer was allowed to deduct the cost of his clown clothes, even his red rubber nose, because his clothes and clown items were deemed not suitable for everyday wear. So this slide, I think, answers the age-old question of which career path is better, lawyer or clown. A great tip that the IRS can tell you to do is to burn your house down. Now, this deals with the ability of a taxpayer to have their house intentionally burned to the ground in order to get a charitable deduction. Now, while this deduction is hotly contested by the IRS, it is possible for a taxpayer to donate their house to a fire department so that the fire department can practice their skills and burn the house down for you. Now, in order to get it right, you must be sure to donate the house and the land to the fire department. This is best done by deeding the entire property over to the fire department. Also, the house cannot be replaced or have already been slated for demolition. Replacing the house disallows any charitable deduction being taken. But if done correctly, you can get a huge tax deduction in the amount of the fair market value of the house and the land. So something to think about as you're driving home. I love giving out good investment tips, and this is a big one, especially since Christmas is right around the corner. Invest in Christmas trees. Now, tip 46 deals with the ability of a Christmas tree farmer to enjoy lower tax rates and upfront deductions. Internal Revenue Code 631 allows Christmas tree farmers to have their profits taxed at capital gain rates instead of ordinary income tax rates like other businesses, as long as they sell Christmas trees that are at least 6 years old. Now, Christmas trees usually fall into this deduction because it takes 6 to 12 years for a Christmas tree to grow to full size. Now, Internal Revenue Code 263A allows a Christmas tree farmer to deduct all of their expenses up front in 1 year. However, other tree farmers and other farmers must wait several years to enjoy the full deduction of their expenses. Lastly, these two rules apply to Christmas trees grown in and out of the United States. Tip 48 deals with the ability of a business to deduct the cost of feeding and caring for cats, so business cats. A 2001 tax court case allowed a businessman who owned a junkyard to deduct the cost of cat food for stray cats. The junkyard owner was feeding stray cats to attract them to his junkyard in order to get rid of his snake and rodent problem. The tax court sided with the junkyard owner, stating that the deduction for the cat items was allowable because controlling the rodent population was an ordinary and necessary expense for a junkyard. Skip 49 and get to what you're all probably going to do anyways when you get out of here as soon as we get done with this slide, is the ability of a business to deduct the cost of beer. Now, all this, although again, this tax court case is very old, it's still a good one from 1982. The Sullivan tax court case deals with a business that spent and deducted over $650 in beer. So $650 is up for grabs here. The beer was then given away for free in order to attract customers to his gas station. The beer was dispensed in an old Coca-Cola vending machine that had the coin operation mechanisms removed. The business owner testified that 95% of the beer was consumed by the customers and only 5% was consumed by his employees. The tax court eventually ruled in the business's favor, allowing the deduction for beer. The tax court stated that beer given away to employees was deductible as an employee fringe benefit, and the tax court also stated that the beer given to customers was a valid advertising expense because the taxpayer was able to show a correlation between free beer and an increase in business. Guys, thank you so much. This concludes our CLE presentation. Thank you for being here so late. Have a good trip home. Take care.